Hi, my name is Elliot Yu, and I'm co-founder and publisher of Energy and Income Advisor. Now, last Thursday evening, the Wall Street Journal reported that energy supermajor Exxon Mobil is close to a deal to acquire shale producer Pioneer Natural Resources. And this is a massive takeover play worth roughly $60 billion. Yes, there's been plenty of consolidation in the shale industry over the past few years. However, this is by far the largest deal we've seen targeting a US-based shale producer. And it would be energy giant Exxon Mobil's largest acquisition in 25 years. Now, whether or not this deal closes, the implications for the energy sector and the price of commodities like crude oil and natural gas is vast. The offer alone reveals one of the most powerful trends underway in global energy markets right now. The truth is, some energy stocks are well placed to benefit from these changes which are already underway. However, I must warn you, not all energy-related investments will benefit. And what really has me worried is that some of the most popular oil and natural gas related investments out there are actually extremely dangerous to own right now. I'm talking about wildly popular and widely held stocks and ETFs that are downright toxic and poised to lose individual investors a ton of cash in the next few years. Now, in this short video presentation, I'll run through the rationale behind the proposed Exxon Pioneer mega deal, what it means for the US shale industry and for commodity prices. I'll also offer some thoughts on stocks and ETFs well placed to profit from the changes underway, and even more important, some specific dangerous names to avoid like the plague. Let's start with this. ExxonMobil's proposed target is, as I said, Pioneer Natural Resources, which is one of the largest producers in the vast Permian Basin. To say the Permian Basin is crucial to the global energy industry is a huge understatement. According to the Energy Information Administration, part of the Department of Energy, the Permian Basin will produce almost 5.8 million barrels of oil per day this month, October 2023. That's more than 60% of all oil produced in the major shale regions covered by the Energy Information Administration's Drilling Productivity Report. And it actually represents around 45% of total US oil production from all sources, which is currently just under 13 million barrels a day. The Permian's share of domestic US crude oil production has ballooned in recent years. Take a look. As recently as the summer of 2015, the Permian Basin accounted for less than 20% of total US oil production according to the Energy Information Administration. But that doubled, more than doubled, to as high as 48% last summer, as you can see on this chart. Now, Exxon already has vast acreage in the Permian Basin, with around 1.6 million acres in the play. Indeed, the Permian is already one of Exxon's 4 focused strategic upstream developments, alongside Guyana, Brazil, and its liquefied natural gas, or LNG investments. According to Exxon's latest long-term strategy presentation, the company expects about 70% of its 2023 to 2027 inclusive upstream oil and gas production investment to be concentrated in just those 4 focus plays. Now, there are 2 main regions within the Permian. There's the Delaware Basin to the west, which is in West Texas and part of southeastern New Mexico, and the Midland Basin, which is located further to the east, centered around the city of Midland in Texas. And that brings me to one of the most important rationales for this deal. Now, Exxon's existing acreage is primarily focused in the Delaware Basin portion of the Permian oil field, while Pioneer is a pure play on the Midland Basin. Now, this map shows Exxon's acreage in the Permian on the left and Pioneer's on the right. As you can see, a deal to buy Pioneer would give Exxon enormous scale and actual flowing profitable production in the Midland Basin, which is the part of the Permian where it's strategically the weakest right now. Such a deal would also push Exxon's total position in the Permian to more than 2.6 million acres, above rival U.S. major Chevron's 2.2 million acre total. I also suspect Exxon wishes to garner more exposure to the Midland portion of the Permian because it's located entirely in the state of Texas. Now, this is crucial. In the Texas portion of the Permian, there are no federal leases. Midland Basin production has no exposure to potential future changes in the federal well permitting process. However, here's what's even more important about Pioneer and why this deal is happening right now. So free cash flow is the total amount of cash a company has left over after covering its cash operating expenses, including capital spending or CapEx. Effectively, it's the amount of cash a company has available to fund shareholder-friendly policies like dividends, share buybacks, or to pay down net debt. Free cash flow yield, which is what's pictured in the chart I'm showing you, is the free cash flow a company has generated over the past year, divided by the market capitalization of the stock. Now, I extended this chart of free cash flow yields for both Exxon and Pioneer all the way back to 2010, so you can see how the trends have evolved over time. For much of this period covered by this chart, Pioneer had a negative free cash flow yield. That's because during the so-called shale boom years, which started for the oil shale producers around 2010, the company was primarily focused on building its acreage position in the Permian and generating production growth, actual barrels of oil coming out of the ground. The increase in volumes of oil coming out of the ground required drilling wells at a rapid pace, and that required an aggressive increase in capital spending over time. In short, shale producers like Pioneer outspent operating cash flow, the money generated from existing operation, from existing wells and production. And to fill the gap, they raised capital by issuing shares or taking on debt to fund that capital outspend. Meanwhile, look at the blue line in this chart representing Exxon's free cash flow yield over the same time. Of course, when commodity prices were generally weak, so periods like 2015, 2016, Exxon Mobil's free cash flow yield fell compared to when commodity prices were elevated, such as, say, 2011 through 2014. However, generally, Exxon's free cash flow yield was far more stable than Pioneer's, and it remained consistently positive, save a very brief period amid the worldwide COVID lockdown-driven commodity price collapse, which happened in the first and second quarters of 2020. This reflects the basic business strategy for a supermajor or major producer like Exxon. The majors generally seek large-scale production projects for the simple reason that a company of Exxon's size needs a large-scale project to move the needle on production. Specifically, majors seek large-scale projects where they can ramp up to a significant production level, a plateau, and then maintain that sort of plateau production for a long period of time, typically 10, 20 years or even longer. For conventional oil projects, like Exxon's offshore developments in Guyana, the oil majors will discover a new field and attempt to delineate its size. So they'll do some exploration drilling. They'll then work on a long-term investment plan to develop the field based on expectations for sort of moderate commodity prices. And only if it makes sense on that basis do they go ahead with the deal. Now, conventional projects usually involve, if they're approved, a capital spending or CapEx intensive phase, where the producer spends to build out infrastructure and drill wells, followed by a cash flow harvesting phase, where steady production with low, stable operating expenses generates consistent and predictable free cash flow for a prolonged period. Now, the nature of shale fields makes production from these plays a bit different. That's because shale is more of a manufacturing process. Now, oil is widely distributed in a major shale field like the Permian, so there is little real exploration risk or danger of drilling a dry hole. Instead, producers producing more oil from a play like that, it's a function of establishing an optimal well design in terms of length of the well, depth of the well, etc. building out infrastructure like natural gas processing capacity to support production, or pipelines. And then most important of all, drilling more wells. However, despite the differences between shale and conventional fields, majors like Exxon have approached their own investments in fields like the Permian much like any conventional project. In Exxon's case, the company currently produces around 620,000 barrels of oil equivalent per day from the Permian, and has plans to reach around 1 million barrels of oil equivalent per day from the Permian by 2027. And that was based on its existing acreage alone. And then it plans to sort of plateau production at about that level over the long haul. Just as with a conventional oil field project like Guyana, Exxon's focus isn't on generating eye-popping long-term production growth. The focus is on reaching a plateau of low-cost, consistent production that can generate free cash flow even at relatively low, modest commodity prices. Now, in the case of Guyana, Exxon has estimated most of its projects there can break even with Brent oil prices as low as $25 to $35 per barrel. And Exxon's long-term Permian Basin break-even target is around $35 a barrel. So just as with all its projects, Exxon's focus on free cash flow means it's always looking for ways to reduce production costs per barrel and improve capital efficiency in any play like Permian. Look at my chart of free cash flow yields again, I'll put it up, and you'll see that starting around 2019, free cash flow yields for Exxon and Pioneer have kind of converged. Now this reflects a fundamental shift I've been writing about and talking about for years now. The US shale business has moved from a fast growth phase to a maturity phase. And the focus is now firmly on free cash flow generation rather than production growth. Larger, high-quality shale producers like Pioneer are now following a business strategy that's very similar to majors like Exxon Mobil. They're firmly focused on cost, capital spending efficiency, and free cash flow. Gone are the days of quarter after quarter of double-digit growth in oil production and capital outspend that were so common at the height of the shale boom years. The implications of this shift are tremendous. On a micro or company level, it makes deals like Exxon's proposed buyout of Pioneer easier to justify financially. And that's because the strategies and cost structures of the two firms are more closely aligned than they were just a few years ago. For example, if Exxon had wished to buy Pioneer in, say, 2014 or 2015, the major would have needed to fund significant ongoing capital spending above and beyond the operating cash flow generated by Pioneer's own assets just to build a meaningful base of production. Even more impactful for commodity markets over the long haul is this. U.S. shale is maturing. A Pioneer-Exxon tie-up underscores the maturity of the shale industry. Increasingly, the best acreage in key shale fields has been consolidated in the hands of larger independent producers like Pioneer and Diamondback Energy. These companies have acquired many of the smaller independent E&Ps with decent acreage in recent years, including both publicly traded and privately held producers. The majors have also been active with smaller deals. Chevron, for example, agreed to acquire PDC Energy back in May, and Noble Energy in 2020, while ConocoPhillips acquired Concho Resources in 2021. An acquisition of Pioneer would be a much larger deal. Exxon is one of the only companies in the world, really, with the size and scale to close a $60 billion plus acquisition, especially given the surging corporate borrowing costs over the past 18 months. Consolidation within the Permian is a direct result of other points I've made in this presentation today. The shale business is all about scale and cost structure. Larger producers, whether larger independents or majors like Exxon Mobil, need to lock down enough continuous acreage to support a long 20-plus year plateau of production in the region, and increasingly the choice acreage is already in the hands of large, well-managed independents with existing cash flow like Pioneer. So it's only natural acquisition activity will turn from small producers to mid-sized players, and finally, with this deal, the largest independents in the region. For commodity markets, the shift in shale acreage from aggressive, fast-growing independents to disciplined majors focused on free cash flow and production costs is bullish for oil and gas prices, the commodity prices themselves. That's because while U.S. production growth will likely continue, the rate of growth will slow dramatically from the frenetic pace so common in the shale boom years and even after the peak of the last cycle in 2015, 2016, 2017. Even in a massive play like the Permian, there are a finite number of premium low-cost drilling locations. So I suspect the majors will focus on long-term development plans that feature a long plateau of profitable production and free cash flow growth rather than trying to drill a bunch of wells and drill through their inventory quickly. Note that this is not a political argument. Even without hostile U.S. government policies towards the energy industry, such as changes in the federal permitting process or drawn-out legal challenges to crucial new pipelines, U.S. oil production and oil shale growth is poised to slow based on simple industry economics and the realities of the size and scale of the resource base. Now take a look at this chart. From 2009 through 2022, global oil demand, this is all over the world, grew by about 13.5 million barrels a day to a total of about 97.3 million barrels a day. Now over the same time period, US only oil production, almost entirely due to shale, grew by more than 10.5 million barrels a day. So in other words, growth in U.S. shale production alone accommodated almost 78% of global oil demand growth. With global oil demand continuing to grow, reaching a new record this year and likely next year as well, and shale production growing at a more restrained pace, the world will increasingly need to rely on other sources of supply to meet growing global demand. In my view, that means oil prices will need to remain elevated over the long haul to incentive the level of investment needed to bring major new global projects on stream. Further, in 2014, rapid unrestrained growth in U.S. shale oil output prompted OPEC, led by Saudi Arabia, to increase production, cratering prices to squeeze high-cost shale producers out of the market. OPEC's efforts to solidify its market share led to that 2014 to 2020 bear market in crude, something I warned about in a series of videos starting in late 2014. However, a slowdown in shale production growth gives OPEC increased influence over global oil prices as a swing supplier of oil. Much as in the early 1970s, OPEC's vice grip over prices is likely to continue until there's adequate non-OPEC supply growth to meet growing demand. Some of that will come from shale, but significant growth outside shale will be absolutely necessary given the maturing shale resource. As I mentioned earlier, there are also vast implications for investors, and I want to cover a few of the most important today. First, and this is very important, I must warn you that avoiding certain dangerous energy stocks and exchange-traded funds, or ETFs, purging these money pits from your portfolio, will be even more important, far more important to your financial well-being than which stocks and ETFs you choose to buy. Let me give you an example. Back in March 2020, this was the height of the COVID lockdown panic and commodity price collapse. I recommended readers of our Energy and Income Advisor service buy shares of Exxon Mobil, of all companies, for the model portfolio. So that may not seem really aggressive today, but at the time, it was actually a very, very controversial decision. You see, at the time, there were widespread articles in the mainstream financial media about how ExxonMobil was forced to borrow billions of dollars, issuing bonds to fund expensive drilling projects and even just to pay its dividend. Others criticized Exxon because of its purported lack of spending on alternative energy investments. Soon thereafter, Exxon became a target of an activist hedge fund called Engine Number One, demanding the oil giant shift its long-term strategy to prioritize climate change risks. When that hedge fund won 3 representatives on Exxon's 12-member board, the mainstream media cheered. Here's the headline from the New York Times went with. You see, the consensus on Wall Street and in the mainstream media was that Exxon Mobil's strategy of investing in major new mega projects to produce more oil and gas was wrong, and that European majors like BP were a better buy. BP, formerly known as British Petroleum, or better known maybe as British Petroleum, was taking almost the exact opposite tack to Exxon in 2020-2021. It was dramatically cutting investment in new oil and gas exploration and development, redirecting billions of annual capital spending in favor of new and alternative energy technologies. Many pundits claimed Exxon's strategy was dead. Global oil demand had already peaked, and alternative energy was the wave of the future. Some even laughed when I pointed out that Exxon offered a near 10% yield when I recommended it in March 2020. The so-called experts claimed a dividend cut was imminent. However, here's how it all turned out. Since recommendation in March 2020, shares of Exxon Mobil have returned more than 147%. That's more than triple BP's 42.8% return over the same time period. And the SPDR Energy ETF, that's one of the most popular exchange-traded funds that tracks the energy sector, is only up about 111%, including dividends. And of course, Exxon never did cut its dividend, and in fact has continued to grow its dividend as we projected back in 2020. So listen, I'm not telling you this or showing you this chart to boast or brag. I'm telling you about our March 2020 Exxon recommendation because it illustrates a very important point about energy investing. You see, I'd argue energy is one of the most misunderstood sectors on the board. And the media coverage of oil prices and energy stocks is downright pathetic. Journalists seem to either take the view that it doesn't matter what energy stock you buy. They all just follow oil or gas prices. That, or the media and many on Wall Street are jumping on hot-sounding trends like ESG investing, solar, and socially conscious investing, with little knowledge or regard for actual data and information about oil supply and demand, profits, losses, and growth prospects for companies involved in these trends. This chart lays bare these lies. Investors who bought Exxon dramatically outperformed the returns in a broad energy ETF like the XLE, that's the SPDR Energy ETF, or in another energy major like BP. And if they'd bothered to examine the reality of energy markets in early 2020, it was fairly obvious commodity prices were weak due to COVID lockdowns, but that energy demand would recover quickly once the economy rebounded. It always happens that way after every recession in modern US history. They'd also probably have seen that supermajors like Exxon historically ramp up investment during commodity price down cycles. They invest in new projects when it's cheap to hire labor, lease drilling rigs, and contract for key oil services when it's cheap to cut deals with foreign governments like the government in Guyana to gain access to resource. That ensures that when commodity prices do cycle higher, as they have, the savvy majors like Exxon have major new projects to ramp up and take advantage of recovering prices. And is it really a terrible thing that Exxon took advantage of its strong balance sheet in early 2020 to borrow money at near record low interest rates? Back on March 19th, 2020, Exxon issued 10-year bonds with a yield of less than 3.5%. Many companies would be ecstatic to see a rate like that these days. Meanwhile, while Exxon has and had several investments in new and alternative energy technologies like carbon capture and sequestration, I believe management was wise to take a cautious approach. After all, Exxon's core competency is in producing oil and gas at a low production cost, and it's unclear if these alternative energy investments would offer a higher return on capital. Recently, BP and Shell, among other majors, have actually decided to scale back their much vaunted new energy technology investments to redirect capital in favor of traditional oil and gas capital spending. That's due in part to the recovery in commodity prices, and probably in even bigger part due to lower than expected returns for an investment from many of these alternative and new energy technology investments. So that brings me back to the current market and some of the names you want to avoid right now, plus some names that actually look pretty attractive. Take a look. Now this is a chart of front-month U.S. natural gas prices since late 2021. Early this year, U.S. natural gas prices truly collapsed, with front-month prices plummeting from around $10 a million BTUs in August of last year to lows under $2 a million BTUs in late March of 2023. The main reasons for this included a warm winter in the US and Europe in 2022-2023, and that reduced, of course, heating demand, plus an outage at a large US liquefied natural gas or LNG export facility in Texas that reduced US gas exports and demand by around 400 billion cubic feet between mid-June 2022 and mid-March of this year. But US natural gas prices that low are unsustainable. At under 250 million BTUs or so, even the lowest cost US natural gas producers struggle to generate any kind of free cash flow. And at prices under about 350, a large sort of key shale field in Louisiana, it's a swing supplier of US gas, known as the Haynesville Shale, is unprofitable to produce. So US producers reduced their drilling activity starting in the first half of this year in response to that falling US gas price. And the result is we're starting to see a decline in US gas production from several key plays around the US. The market supply and demand balances are tightening, and gas prices have started to recover, as you can see in my chart. However, longer-term US gas producers over the longer term anyway, U.S. gas producers need prices to average close to 4 for the U.S. gas market to balance, especially with U.S. Opening up several new LNG export terminals by the second half of 2024 next year. So how do you invest to benefit from the recovery of U.S. gas prices and a rebalancing of this market? How do you benefit from soaring U.S. LNG exports as we move into 2024? Well, one popular avenue, something readers ask me about frequently, both by email and at conferences where I speak, is to buy a natural gas exchange-traded fund like the U.S. Natural Gas Fund, traded under the symbol UNG, or the ProShares Ultra Bloomberg Natural Gas ETF, traded under the symbol BOIL, B-O-I-L. Note that these ETFs do not track shares in companies that produce natural gas. Both UNG and BOIL track natural gas futures prices. Now, UNG is designed to rise in value by 1% for every daily 1% increase in Henry Hub natural gas prices. And BOIL is designed to rise 2% for every 1% daily increase in the price of natural gas. So that seems like a pretty direct way to invest in higher natural gas prices, right? And if you could buy UNG, for example, when gas prices dip back to around or under 3 and gas jumps to 4, that's a more than 30% gain, right? Seems pretty straightforward. Let me make this absolutely clear and unambiguous. If you're an investor, ETFs like UNG and BOIL are one of the most dangerous energy-related investments you could ever make. Indeed, with BOIL, as I'll show you in a minute, you are almost guaranteed to lose money if you hold it for longer than about 5 or 6 months, even if U.S. natural gas prices rise significantly in value when you hold it. Let me explain. Earlier on, I showed you a chart of front-month U.S. natural gas prices. Right now, the front-month price of natural gas is a contract for gas delivery in November 2023. And gas sells on that basis for delivery next month for about $3.39 a million BTUs. However, the front-month price of U.S. gas tells you little, very little, about the health of the gas market. Now, this chart shows what's known as the U.S. gas futures curve. It shows the price of gas for delivery in every month from November 2023 through the end of 2027. As you can see, there's a seasonal variation in gas prices due to the fact that gas demand for heating is higher in the winter months. There's also a general drift higher in prices out to 2026, 2027. So when you buy an ETF like UNG or BOIL, you're not really buying natural gas at current low prices. The ETF owns a certain gas futures contract and then rolls from that contract to a later dated contract according to a preset roll schedule. And it's a little different for every ETF out there. For example, if the ETF currently owns November futures at $3.39 a million BTUs, it would need to roll out of that contract to, for example, the December 2023 or January 2024 gas futures, which are currently trading at 364 and 385 million BTUs respectively. Now there's a cost to this roll process. In many cases, it might only be a small cost each month as you sell a cheaper contract and buy a more expensive contract. But it adds up and compounds over time. The impact on your returns can be significant, and it only grows the longer you hold the ETF. Let me give you an example. 3 years ago, in October 2020, US front-month gas futures, which were then the November 2020 contracts, sold for under 270 a million BTUs, compared to, as I mentioned, 339 right now. That's about 25% gain in front-month prices between October 2020 and October 2023. However, over the same period, the UNG ETF has plummeted more than 36%. The BOIL ETF is even worse. It's a leveraged ETF that tracks daily changes in the price of gas futures. So if nat gas prices go up 5% in a single day, BOIL should probably be up about 10%. However, when you compound daily price changes on a leveraged basis over holding periods longer than a day, BOIL does not track changes in gas prices well. For example, if you hold BOIL and gas goes up 5% in a day, as I said, BOIL will probably be up about 10% that day. Or if gas prices rally 5% in 2 months, it's quite possible, likely, BOIL will be up a lot less than 10%. In many cases, it's even down over an equivalent holding period. Let me give you a specific example from this year. This chart shows the performance of 3 potential natural gas investments since March 29th, 2023. That's this year. I chose that date because on March 29th of this year, front month US gas futures closed at $1.99 a million BTUs, compared to, as I said, $3.39 today. So let's assume you thought gas sub 2 is too low. I agree with you. Now, and more importantly, I wrote exactly that in Energy and Income Advisor back in March. Heck, I was even on a popular podcast back in late February with thousands of views this year, saying gas prices in the low 2s, 225 or so at that time, were too low to be sustainable. And that view was right. US gas front month futures are up to $3.39 now. Well, if you bought the US natural gas ETF, that's the UNG ETF I talked about earlier, you'd be up only 13.9% if you bought on March 29th, 2023 and held through today. That's because the futures calendar roll cost I outlined earlier. And if you bought BOIL, the leveraged bullish gas ETF I mentioned earlier, your return over the same holding period would be a loss of about 4%. Again, that's due to the combined impact of calendar futures roll and compounding decay I outlined earlier. I speak to investors all the time who buy ETFs like UNG and BOIL, watch gas prices rally over time, and still lose money. Warning, unless you're a trader looking to track natural gas prices over a few days or a few weeks, avoid ETFs like UNG and BOIL. Instead, consider a natural gas-focused producer with low production costs. One of our favorites is a producer called EQT, which trades under the symbol EQT, and they own vast acreage in the Marcellus Shale field in Appalachia. Now, each quarter, I take a deep dive into results from all the major US gas shale producers to assess their production costs, production growth prospects, and their hedge coverage. I use this to derive an estimate of their ability to generate free cash flow over time. EQT consistently has among the lowest costs of any shale producer in the US. They can generate free cash flow even with gas prices in the mid to low $2 a million BTU range, while many of their peers are burning through their cash piles, even taking on debt to support their current operations. I depicted EQT as a gray line on my chart here, and as you can see, buying EQT on March 29th produced a total return of almost 42%, including dividends. Much better than UNG, and certainly a heck of a lot better than the loss you would have sustained in BOIL despite surging US natural gas prices. Well, there you have it. In this video presentation, we've covered a lot of ground, including a deep dive look at the proposed megamerger between supermajor Exxon Mobil and Permian-focused shale producer Pioneer Natural Resources. How the Permian Shale field alone has accommodated 78% of not just U.S. oil demand growth, but global oil demand growth since 2009. While production growth from the Permian Shale will decline and why that's bullish for oil prices. We examine the crucial importance of stock selection when investing in the energy supercycle currently underway. Why the mainstream media so often chases ridiculous narratives about energy and oil and gas that cost investors a ton of cash. How your long-term returns from investing in energy can depend as much on the stocks and ETFs you avoid as to what you buy. We even looked at one of my favorite ways to play long-term growth in the US natural gas market and LNG exports, and why ETFs like UNG and BOIL are so dangerous for investors. I cannot go through all of my top recommendations, plus my blacklist of stocks and ETFs to avoid in this short video presentation. However, I've decided to open up risk-free trials to our Energy and Income Advisor service for a strictly limited time. Here's how it works. To start your risk-free trial, simply click one of our 3 membership options located below this video. We have a quarterly, annual, or a deeply discounted 2-year option. And it will take you to our secure order page. Then you'll gain full access to all Energy and Income has to offer for the next 30 days. Check out our frequent issues and alerts covering key trends in the energy industry and some of the best placed stocks and ETFs to benefit from these trends, as well as I said, stocks to avoid. Check out our model portfolios covering our top recommendations, including position sizing recommendations, buy under and target prices in several energy sectors, stocks for investors interested in income and dividend yield, stocks for growth, and names to avoid. And participate in our next monthly online chat that's going to be held on October 26th this month. Our chats are the most popular feature of the service. Your opportunity to ask me and my co-founder Roger Conrad any questions you like about energy stocks, commodities, the economy, the stock and bond market. You can even ask us for our favorite restaurant picks in various cities. Ask anything you like and we'll answer all your questions live on the chat. Some chats have lasted as long as 9 hours. We answer every question in the queue before ending the monthly chats. No other advisory service we know of offers a similar feature or level of service for readers. And the best part of all is that the chat is entirely written. You type in your questions and we answer them in written form. We then bundle all of the Q&A into a PDF file you can download to peruse when it's convenient for you. Can't attend the chat live? Also no problem. Simply email us any questions you have up until 5 minutes or so before the chat, and we'll answer them live on the chat itself. You can read the answers on the Q&A PDF file we send out. In short, test drive all Energy and Income Advisor has to offer, and if you're not 100% convinced it's worth every dime of the membership price, simply call or email us and cancel your membership for a full refund. No questions asked and no hard feelings, I guarantee it. To start your risk-free trial, simply tap on the button below this video to get started today. Or if you prefer to order by phone, call us toll-free on 1-877-302-0749 anytime between 9 a.m. and 5 p.m. Eastern Time, Monday to Friday, and place your order with our customer service manager, Sherry. Thanks again for listening. Again, to start your risk-free trial, simply tap on the button below this video to get started today, or call us by phone 1-877-302-0749 between 9 a.m. and 5 p.m. Eastern Time. Here's to your wealth. Thank you very much again for listening.